If anyone.
Okay, I'm sorry we're having some technical issues, but our technical team are making an effort to sort that out. Just bear with us. I'm sure they will improve. Are we on?
Yes.
Okay, thanks so much. As mentioned earlier, the essence of having this e-conference and award program is to be able to extract knowledge about the management and practice of mutual funds in Nigeria. And in order to be able to achieve this, we've put together a what I refer to as super panelists on mutual funds. These are experts in the industry. We have Ifeoluwa Dixon, and I would like to invite Ifeoluwa Dixon to introduce herself. Is she there?
Yes.
Good morning, everyone, and thank you, Business AM, for having me here. Like the moderator has introduced, my name is Ifeoluwa Dixon, and I work with FBN Quest Asset Management. I'm a portfolio manager in that space and to oversee the fixed income desk specifically of FBN Quest Asset Management. Thank you.
Okay, thanks so much. Next on our list is Bamidele Ige. Bamidele Ige is the managing director of PAC Asset Management Company. It's one of the leading performing mutual funds company in Nigeria. But I would like to give Bamidele Ige the honor of introducing himself as well.
Good morning, everyone. My name is Dele Ige. My full name is Bamidele Ige, but I like to be called Dele Ige. I work with PAC Asset Management. I'm the MD, and currently we manage 5 mutual funds, including the PACAM Balance Fund, the PACAM Money Market Fund, the PACAM Fixed Income Fund, PACAM Eurobond Fund, and the PACAM Equity Fund. So I think I'll just keep it as short and simple as that, and then I'll hand over back to our coordinator. Thank you.
Yeah, thanks so much, Bamidele. Thanks so much for joining us. Next on our panel is Odiri Ogini. Odiri Ogini is the managing director of United Capital Asset Management Limited. I want her to introduce herself as well.
Good morning, everyone, and thank you, Business AM, for the CEO of United Capital Asset Management. United Capital Asset Management currently manages about 7 mutual funds across various asset classes, from fixed income to the Eurobond fund to money market, as well as the equities asset class. And we also manage investment across both Naira.
Thanks so much. Nice having you here. When we set out to have this program, the first panelist that came to our mind was Temitope Omojoku. Because of course, when you're having anything on an industry, you have to look at the industry regulator, and you have to ask yourself, who are the people actually directing the affairs of that, either the regulator or the governing body of that industry. So we have the president of the Fund Management House of Nigeria on our panel as well. Her name is Temitope Omojoku. I don't know, I want us to actually check whether she's around. Temitope Omojoku. Okay, while waiting for Temitope Omojoku, we have a professor in the house, Professor Owaleke Uchenna Joseph. Professor Owaleke Uchenna Joseph is when we started discussing this, the first person that the publisher mentioned is Professor Uche Owaleke, of course, because of what he has to offer. So, Professor, we want you to introduce yourself.
Yeah, thank you very much. and good morning, everyone. I hope you can all hear me. The audio quality is still not good. My name is Uche Market at the Nasarawa State Theoretical Perspective.
Professor Uche, I think we're having some problems. I think the audio quality is bad, and we wanted to take some time to probably to take it again. We want to know more about you. Is the slides ready?
All the systems are not connected. This is what I've been trying to do. I'm using this.
Hello. Yes, I was saying I also have some industry experience. I'm a broker. I've also worked for an investment bank, and at some point I was chief economist and director of research at the Securities and Exchange Commission. Thank you very much. It's my pleasure to be with you.
Super panelists for today, and like I said, they are going to be discussing the practice and management of mutual funds in Nigeria. So without wasting much of our time, I would like to hand over straight away to Professor Uche. Professor Uche will be presenting a paper. He'll be presenting a paper on, sorry. Okay, Professor Uche will be giving a keynote address on the benefit of mutual funds in Nigeria. Thank you.
Okay, thank you very much. Yeah.
Professor Uche, are you still there?
So enable the right to me.
Having serious problem hearing you. The voice quality is not good.
Yes, Yeah, but I can hear you. I'm only asking you to enable me to share the screen from here. I could go ahead
Yeah,
and talk
thanks so much.
the audience can hear me.
Yeah, you can go ahead. Our technical team are they're already working on the slides.
Oh, okay. All right. Please share the screen from
Thank
there,
you.
if you can. Well, I decided to title it, title my speech, Leveraging the Potentials of Mutual Fund in Nigeria. We all know that a mutual fund is a fund that pools resources, pools funds from various investors, for the purpose of investing in a portfolio of assets. This portfolio of the asset classes, of course, may involve money market and capital market, bonds, shares, including real estate. Now, the first mutual fund was set up in 1774 by a Dutch merchant. Since then, the mutual fund industry has grown such that as we speak, we have over 100,000 mutual funds, with a majority of them in the United States. In the case of Nigeria, the mutual fund took off significantly in the 90s, following the implementation of the deregulation policy. I'm aware that somebody will be talking about the classes, but we know that the investment objective is the major determinant of the class, whether it is a money market fund or equity fund or fixed income fund, real estate fund, bond fund, ethical fund, or mixed fund. But regardless of the class, there are two types. We have open-ended and closed-ended funds. For the purpose of some participants who may not be aware, in the case of open-ended funds, the fund can continue to offer registered units, while framework for mutual fund in Nigeria is the Investment and Securities Act of 2007, specifically Section 13H. It's also supported by SEC rules and regulations made pursuant to the ISA. So what are the benefits of mutual fund? And we often argue that mutual fund represents a veritable means of investment for investors, especially retail investors, individual investors who may not have the time or who may not have the skill or the knowledge to, so the mutual fund will provide that investor with professional management. There is also diversification and spreading of risk. It also enables the investor to invest in various assets using a small amount. You can imagine if somebody with 100,000 or 200,000 attempting to buy stocks directly. If the person is interested in Nestle, for example, that is over 1,450 naira, or Airtel Africa 950 or point of view, we often classify into systematic and non-systematic risks. Systematic or general risks affect all firms or the entire industry, the entire economy. So of course, the mutual funds are not shielded from systematic risks, specific risks. These are unique to the industry and unique to the firm. So sometimes you'll find cases of inappropriate valuation or lack of due diligence, market abuses on the part of any of the parties. The parties to a mutual fund include the sponsor or the promoter, the trustees, the fund houses, that's the asset management company, and the custodian. So it is the duty of the Securities and Exchange Commission to regulate and supervise the activities of these parties with a view to mitigating the risks. And some of the measures put in place to mitigate these risks include the fact that mutual funds are structured under a trust structure with independent oversight by a trustee that acts on behalf of investors. Of course, this ensures extra layer of investor protection. There is also the issue of asset segregation, which requires that assets are segregated. The funds are placed with custodians, independent of the fund manager and the trustees. This safeguards the assets from commingling and any authorized used by fund managers. So I have some stylized facts on the Nigerian mutual fund industry, the various types of funds, and their contribution, their share, industry share as of 31st of December 2020. Okay, that's beautiful. That's the presentation. Okay. Yes, please go ahead. Yes, this is about the background, the brief history of mutual fund, the classes and types which I talked about, the benefits and risks, and then we are here, the stylized facts. You can see that money market fund is accounting for the largest at 49%. This is as of 31st December 2020. Ethical funds 1%, mixed funds 2%. So the bulk is in money market fund and fixed income funds at 28%. This is sourced from the Securities and Exchange Commission. Can you go down? Next slide, please. So, okay, so as of December 2020, the sector's total asset under management, 49%, I said this earlier. In Nigeria, equity-based funds are only 1% of Nigeria's mutual fund. In comparison, it is about 17% in Ghana, 19% in South Africa, 46% in the United States, and 59% in the United Kingdom. Next. The next slide is of the numbers we saw earlier. The next slide, please. Okay, we have talked about this. The bulk is in money market funds. Well, for understandable reasons, treasury bills and some money market securities for a long time, have proved to be quite attractive in terms of security, in terms of also returns.
our internet. Hello, Professor. Let us be looking at these slides. I guess we have some issues with Professor Uche's internet.
Net asset value has moved from just 173 million to over 1.5 trillion as of December 20. So the point is this. Okay, so this is what I was saying. That despite the growth in recent years, the potential 2020, whereas Nigeria has the highest population in Africa, yet population as a percentage of the population is least in the continent at 0.22%. So a country of 200 million people with participation at just 441,000, you can see is quite dismal. Now, according to globaleconomy.com, mutual fund as a percent of GDP average for 2017, based on 4 countries, was 21.55%. The highest value was in South Africa at 52%, and the lowest value was in Nigeria at 0.35%. So the point here is, even as a percentage of GDP, the mutual fund contribution is very, very low, 0.35% in Africa. Next slide, please. So you can see mutual fund asset as a percentage of GDP as part of our industry challenge. Look at South Africa is 52%, Namibia, the 31.7%, and you can see Nigeria taking the rear at 0.35% as a percentage of GDP. Again, we note that mutual fund, we have seen the growth of mutual fund.
I think Professor is offline. The network is bad. One day we are going to get over this thing very soon in Nigeria. Professor, we can't hear you at all. Let's see the slide. Please look at the slides. You actually understand the data that Professor is referring to. Actually, when I saw the data too, I was surprised.
let's go to that. Okay, the industry challenges. The industry challenges, there are mutual fund penetrations. It tends to be concentrated in large cities, especially Lagos and Abuja alone. You said?
Okay, my apology for the disruptions. Let me quickly round off. I'm sure you get the presentations later. So I talked about mutual fund penetration that is weak. Now, of course, the outlook is bright for 2021 and beyond. There's no doubt about that. Go to the next slide. Nigeria has a huge population, is a great asset, mainly youth. The country's economy is the biggest in Africa and highest mobile penetration. So how do we tap this potential? It will require extensive research into reasons patronage of mutual funds in many parts of the country. It will require a coordinated approach to investor education with an emphasis on savings culture. So it's not just investor education, but there must be emphasis on savings culture. And I've always said that investor education approach will target students, especially those in secondary schools and tertiary institutions. I have always said it, that if you look at the population of tertiary institutions today in Nigeria, in the university, for example, where I work, as of July last, about 2 million. Okay, you have 2 million enrollments. You have close to 5 million. Okay, so if we do a lot of investor education, you can be sure that in the near future, the mutual fund industry will grow. That is the story of Brazil, which of course is one of the countries with very strong mutual fund industry. It's also the story of India. So investor education is critical. I'm not saying it should be restricted to educational institutions. Of course, there are other channels of investor education, that can be used. But I am saying that ensuring that mutual fund collective investment schemes, the capital market knowledge is taught in our educational institutions. We go a long way in helping the mutual fund industry, because that is the industry for small savers. We should also leverage technology and integrate mobile networks and telecom companies in diversification of distribution channels for products. I recall that in 2014, India even had to partner with the National Post Office in order to enhance the distribution of mutual post offices. So in Nigeria, as I said, we can leverage technology by bringing in the mobile networks. In Kenya, for example, there is a project that World Bank supported, known as the Treasury Mobile Direct, under which investors, small investors, can invest just by using their mobile phones. So mutual fund industry will grow. Again, making mutual funds tax friendly to attract more investors and increase penetration is critical. So in conclusion, I want to submit that mutual funds represent the best vehicle of investment for retail investors who do not have the time or knowledge or skill for direct investment in the capital market. It's a veritable channel for achieving financial inclusion and mobilizing resources resources from informal sector to achieve more capital formation. Despite the modest growth we have seen, the mutual fund industry measures. But nevertheless, the size of the economy and the mobile penetration, the outlook for mutual fund industry in Nigeria is very bright. And what is required is a coordinated approach to investor education and using technology as much as possible to increase the reach, I think, enhance participation. So mine is just to set the tone, to provide the context and the background. I'm pretty sure that the other experts in the panel will speak more to the issues I've raised here. So distinguished ladies and gentlemen, let me thank you for listening, and let me also thank Philip, my good friend, for giving me this opportunity. Thank you very much, and apology for the network.
Thank you so much, Professor. You've given us a very comprehensive presentation. It's actually difficult to ask questions because you've covered everywhere we actually planning to ask questions on. But let me start with other panelists now. Mr. Bamidelege. Though you said you prefer to be called Delege. Delege, one of the challenges raised by Professor is the concentration of mutual funds in mainly large cities, especially Lagos and Abuja in Nigeria. How do you think we can overcome that challenge as a nation?
Okay, thank you for that question. And I'd like to state that, so in 2017, we conducted a study and we discovered that we came to the same conclusions that Professor Uwaleke came to. And we found, like he said, that there's a concentration of investors in the mutual funds in the large cities, Lagos, Abuja, Port Harcourt, not so much in the northern commercial centers. We also found that aside from the concentration in those cities, you find out that the people who largely invest in mutual funds are people who have financial industry experience. You know, that's another leg to it. You're not likely to find many engineers investing in mutual funds because, I mean, the simple explanation is that they're not familiar with that terrain. In the finance industry, people who invest in that, it's because they have some form of knowledge. So I think the answer to that question is investor education on the values and benefits of a mutual fund investment. The professor has alluded to some of the benefits, being the fact that, look, as an individual investor who wants to approach the market, you do not have enough capacity to negotiate good deals. For instance, you have 100,000, you take it to a bank, you probably get the lowest rates. If you're putting funds with other investors and you're approaching the same bank, then you're in a better position to negotiate and get better value for your money. So for me, that is the short answer to that question.
Thanks so much,
Thank you.
Delege. My next questions will be to Ifeoluwa Dixon. You know, one of the suggestions that Professor Uche mentioned is the adoption of, innovative adoption of information technology for easier access of mutual fund penetrations. Especially, I think banks have been able to cross that corner. Personally, I hardly go to banking halls because I can do most of my transactions on my banking apps. So as the vice president of the Fund Management Association of Nigeria, what do you think the industry players are doing to adopt IT so that more people can be brought into the industry? That question is for Ifeoluwa Dixon.
Yes, thank you. And even before I answer your question, Tokwe, who is the president of FMAN, was on the call as well. But she had to drop off because we have another meeting with SEC, CMC, Capital Market Conference, ongoing about the same time. And both of us, the president and the vice president, can't be absent at the SEC meeting. And so she came in, but she had to drop again. and to attend to that. And maybe in the course of this meeting, she might be able to come back. But I have a presentation, just in case you still want her to go through a presentation.
No.
But going back to your question, just like you said, that what is the fund management industry is doing as regards technology. In our own little space, right, different houses have adopted or embraced technology. We have some firms who has their apps, on the mobile. So very easy for people to onboard, very easy for people to subscribe and even to redeem their funds without necessarily coming into the mortar or bricks and mortar offices of the fund managers as well. Some people have gone the way of USSD to make it easier and even for financial inclusion as well. Some people, they've partnered with agencies, mobile money agencies, right? Just to deepen the asset management industry as a whole. So yes, gone are those days that technology or digital will be a fancy word, but now it's a tool that everybody needs to embrace if you want the industry to grow, or even your own share of pocket as well, wallet to grow. Technology is just a no-brainer for anybody. And so on the side of the industry as a whole, yes, everyone is tending towards that, just like where the banks are, whereby you can download an app and do all the transactions without speaking to anybody. We have global advisories as well, whereby you answer certain questions based on what has been programmed, and then we'll tell you your risk profile and the kind of investment you're likely to do, and that you won't get burnt in. And so, yes, the industry, on behalf of FMAN, will embrace the technology as a whole.
Thanks so much. Presentation. Naturally, we were expecting her to actually explain to us how mutual funds works and the different types of funds that are available. So if you have the presentation, we will be very happy to have that. Thank you.
All right, so should I move on to Tokwe's presentation then?
Yeah, you can move on to Tokwe's presentation before we go to the next session. All
right. I don't know if you have it or you would like me to share it.
You can share it.
Just see. I'm not sure I have the right to share.
Okay. Our technical team are already working on that. They are listening, they are watching. Right. So. Yeah, you can share it, yes.
Still can't share at the moment.
Okay, they said you should try again.
No, I can't. I don't have the permission.
Okay, or if you can forward it to our mail, someone will attend to it. It will be shared with so that our technical team can. Okay, they said you should try it. That I think you've been given permission. You've been granted permission.
Yeah. Hello, Tony. I think all you need to do is to transfer the hosting rights to her.
Exactly. I don't.
So when she's done with the presentation, she will also do transfer to you.
I'm not.
To enable her share the screen.
The hosting right has been granted. The hosting right has been granted already.
No, I'm not. Okay, now I am.
Yes. Okay. Thank you.
Okay, you know what? Not to delay people, I'm just going to send, and if we
Okay, you can
share.
send it to our email address. Someone will pick it up from there.
Go ahead, that's what you do.
If you can confirm receipt.
I think someone just sent you a message now. Via Zoom. You have access.
I can actually start, right? So while we get it sorted.
Yeah, you can start. You can start. They are already working on that so that we won't delay people.
All right, so thank you. And I guess the topic is overview of mutual funds. Would like to start by even giving a brief understanding of what the Fund Managers Association of Nigeria is all about, right? And it was established to promote awareness of CIS majorly, and also to bring fund managers in together, and we share pains and to ensure standardization really, and then the layers with FMAN, then layers with Securities and Exchange Commission on behalf of the industry. And so FMAN is a self-regulated association. So we are self-regulated and we're being supervised as well by SEC for registered fund managers. And also objective of FMAN is to ensure observance of global best practices relating to the operations of such fund managers. And those fund managers must be registered with SEC. And also to educate the public on investment and the operations of its members. And the whole essence is just, people are aware of what they are meant to do. And this is to the investing public rather than putting your money into Ponzi scheme and the likes of MM just disappear. And hence why we stress SEC registered fund managers, right? And this is what the Fund Managers Association of Nigeria is established to promote. The speaker before me has mentioned where the industry in terms of net asset value is, which is about 1.5 trillion. And that got across about 110 registered mutual funds. We call it Collective Investment Scheme, CIS, including exchange traded fund as well, ETF. And we've seen the data that we've been shown earlier before now, where we have close to 49% in the money market and 29% thereabouts in fixed income instruments. What else again is FMAN all about? It's all about awareness. Like I said, we educate the public, and for us, it's about catching them young. And so the previous Global Money Week, last 2 years, because none was held last year because of the pandemic, these are pictures of us going around secondary schools, just to educate the younger ones about investing aside savings. And even if it's savings, even your 1 naira, what your 1 naira can get for you. And also for us, right? And so I'll move into the CIS space. Like I said, CIS, another word for it is mutual funds, are registered investment vehicles set up by licensed professional fund managers. And I want us to dwell on the word licensed professional fund managers. So this is not a replica of, we are not a replica of whereby we get money today or we get money today and then we disappear into the 10 year. No, we are licensed professional fund managers. And the purpose is to invest on behalf of a group of investors referred to as unit holders. Every CIS is registered by SEC, which is the Securities and Exchange Commission. Again, they oversee, they regulate, and they monitor what we do, so that, not the case of I give House A money and the next moment House A has disappeared. No. The speaker before me has alluded to the fact that we have trustees and we have custodians as well. What is the work of the trustees? They represent the interest of unit holders, and they have a constitution, just like the Constitution of Nigeria, that is called the trust deed. The trust deed is enshrined with laws, the do's and the don'ts of what a mutual fund can do. And the trustee that is representing the unit holders then ensures that what is written or stated in the trust deed is what the fund manager is doing on behalf of the unit holders. The custodian, on the other hand, is where the funds, unit holders' funds are being domiciled. Assets as well are being kept with the custodian. And the good thing about CIS is the fund is not registered in the name of the fund manager. So even if Fund A house, if the fund manager should disappear tomorrow, either through bankruptcy or whatever, and license is being withdrawn, the assets are held with the custodian in the name of the fund. And that can automatically be moved into another fund manager's house. And so by and large, investors or unit holders are not going to lose anything. So it's not a case of, because Fund A, House A has disappeared, or is no longer in operations, unit holders are going to suffer. No. And that's the beauty of mutual funds, or if you like it, CIS. And so CIS investors, with as little as 1,000 naira, you can invest in a mutual fund. Hence why we even, we moved out to secondary schools to educate them, to say, your pocket money, you can save 1,000 out of it, and it's going to earn you something. Because the beauty of it is, it's called mutual funds or collective. We pull funds together. So your 1,000 will be pulled together with somebody that's given the house a million naira to the same house who has 100 million naira, and you're going to share the returns accordingly. Not in terms of your participation or contribution. Is going, if it's 5% that the fund is returning, the 1,000 naira person as well will get the 5%, which is the beauty of the mutual fund. Moving on to the next one is just to show us the structure of the CIS. I've mentioned that every mutual fund that we have in the market today is being approved by SEC, which is the Security and Exchange Commission, right? And they oversee what any licensed fund manager is doing. A layer to that is the trustees that I've mentioned, custodians that I've mentioned. Another one is the registrars. And what's the work of the registrars? Pretty much is they just keep the register of unit holders. They keep your unit holdings for you. When there is any communication, it's been disseminated via the registrars. And this other structure is just showing us how it moves around, right? The collective investment scheme from fund managers, you invest, the return is being given, we distribute returns, investors are happy, and they bring in money back into the fund, like that. And so my next slide will still on the overview. What are the benefits, right? Benefits for a CIS cuts across. The last speaker mentioned two schemes, which is open-ended and closed-ended. And largely what we have in Nigeria currently, most of the mutual funds are open-ended. We have closed-ended, but most of the mutual funds are open-ended funds. And that gives liquidity. Liquidity in a way that, you know, when you want to exit the fund today, the fund manager is meant to provide liquidity. So the fund manager will buy the units of the unit holders in exchange for money. And so liquidity, you can liken that to your savings, most especially for the money market ones, you know, and it's the low cost to it. Today, if you want to buy a federal government bond, you know, and you want to go as an individual, a house can tell you you need to have 100 million or 200 million. And if you have 100 million you want to sell, then it might be difficult because it's not up to market standard. But if you invest in a fixed income fund or a bond fund, you know, with as little as 1,000 naira, 50,000 naira, you can move out at any point in time. You can go out if there is a liquidity need. But if you're just in a single fund, one, it will be difficult for you to get it at 50,000, even the savings ones that federal government is doing. When the time is ripe for you to exit, if there is an emergency and you cannot wait till maturity, it's difficult for you to sell. And that is what the mutual fund creates, liquidity and the low cost of it. And the mutual funds as well will give good returns, competitive returns compared to what a single investment would have given you if you had gone in as a solo investor in the market. And you have the expertise of the professionals as well. And we speak about diversification. And so we've mentioned, and if you look at the presentation of the last speaker, we have different mutual funds. We have the balanced, we have equity, we have bond funds, we have Euro bonds. It cuts across, which means diversification rather than you putting all your money into a particular stock or into just one instrument asset class, say treasury bills. You can share it, and then diversification will diversify the risk and the returns as well. And the convenience, like I mentioned, the convenience is now there. You can download an app and just do your subscription and you redeem without speaking to anybody in the at the other end. And personalized service, what do you need? If it's needs, then you know it's been rendered as well. And transparency, every fund manager is meant to put on certain things on their website for people that can easily go to. A good one will be the historical returns or historical yields or prices, as we may call it, depending on, and the fact sheets of the fund as well. Fact sheet will tell you the total expense ratio. Fact sheet will tell you what's been going on in the fund, how the market has reacted, and how the fund as well has performed. So transparency is key when it comes to mutual funds. And we have categories of CIS. The last speaker as well as mentioned this, the money market fund. Underlying assets of that is treasury bills, commercial papers, bank deposits. What's the objective is for investors who are seeking for capital preservation and to maintain a high degree of liquidity. The portfolio risk profile is low. The time horizon is short-term horizon, which is less than 1, because for most of holding period, it's about 30 to 90 days really. And income is being distributed as stated in the trust deed. Like I said, trust deed differs. Some houses will tell you quarterly, some might tell you semi-annually or even annually. It all depends on what's being stated in the trust deed. And as of today, according to SEC, the total expense ratio of any fund can be greater than 3.5%. We have the bond fund, which is also called the fixed income fund, that can invest in sovereign bonds, which could be state bonds or FGM bonds and corporate. 70% of that is meant to go into bond anyways, and 30% into money market instruments. The objective of the bond fund is to create stable income and also, to diversify portfolio away from just pure money market. Risk profile is low to medium, time horizon is greater than 2. On the equity side, on the balanced or mixed funds, then you have a slice of equity. And this, the beauty of the balanced fund, really, it speaks to diversification, because you have bonds, you have money market securities, and then you have equities in it. And the risk is moderate, and it's moderate because of the equity portion in there. And the time horizon is medium to high, and so you expect it to be greater than 3 years because of the equity portion in it. Income is being distributed as it's been stated in the trust deed. And like I said, none of the funds that we have today can have a total expense ratio greater than 3.5%. I'll move on to equity, and equity is just equity, whereby about 70 to 80% of the underlying assets has to be invested in the Nigeria companies, listed on the Nigerian Stock Exchange, and then 20% or 30% can then go into the money market or bond space. We have dollar-denominated funds as well, and the dollar-denominated funds will just invest basically in any US dollar instruments, right? And so the beauty of this particular fund, again, to any investor, is it creates an hedge, for anyone who is looking to invest in dollar instruments. And like we note for today, it's a no-brainer for anyone to just invest in the dollarized fund. And so the dollar-denominated funds, they have that. And for faith-based investors, those that are ethical, those that will not want to do anything outside of their belief, faith, we have the Sharia compliant funds. I love to call it faith-based funds, right? Just because some people can say, but it's more of ethical and another layer of an ethical fund. And so these funds will not touch anything that has interest element or that is not asset backed. I think the word I want to use is asset backed and not interest, because we have some, we call it returns anyways. And these kind of funds, we just invest in Sukuk or any Sharia compliance contracts. And investment objectives, it's same: capital appreciation, capital preservation, and the risk profile is moderate to high. And high if you have equity in your Sharia compliant fund. We have the NAV, and the NAV, I will not dwell so much on it because that has been shown to us. But what I want to stress is it's still growing, and we expect it to grow. And the past 5 years, the NAV has grown tremendously by 480%, representing an average yearly growth of about 96%, and despite decrease in nation's GDP. The last speaker has shown us that even the contribution to GDP is still less than 0.5. Would love that to grow. But by and large, with the way people are investing, yes, demographics are shown that it's just Lagos, Nigeria, and a bit of Port Harcourt. But again, it shows that people are willing to invest the little money that they have rather than to consume it. And I think that is all really. For the CIS versus traditional savings, what it gives is gives a competitive return than what you would get if you just put your money in savings, right? Or even in current accounts. And like I said, liquidity is there. And so some houses do 24 hours, if not 12 hours redemption. And so these are things that should encourage people to come into the mutual fund space. And distribution channels, you have mobiles, you have USSD, you can go onto web, some people's online, and then you get signed on immediately. Or strategic partnerships. I've mentioned earlier on this call that we have houses that partner with mobile banking or mobile money agencies, right? And so strategic partnerships as well would deepen the market for us. And thank you so much. That is the president of FMAN's presentation. Thank you.
Okay, thanks so much for a beautiful presentation, Ifeoluwa, on behalf of the president of FMAN. But I have a question, and Thank you so much, Ifeoluwa, for a beautiful presentation. But of course, while analyzing the performances of all the funds in Nigeria, we realized that some mutual funds have actually not been given the desired results. Even some of them have been, over time, they've been giving negative returns, meaning they've been making losses. So as an investor, how are you protected when the mutual funds you invest in don't give you the desired returns? What does FMAN do to protect me as an investor?
So, good question. And I would say it's a reflection of the market. I do not know the fund you're speaking to, but I want to say the category of that fund will be equity, right? It will be an equity fund. I do not expect a money market fund to give a negative return, nor a bond fund to give a negative return. And so it has to be equity fund. And when you then look at the equity fund, it's a reflection of the market. Last year, most of the equity funds would, be in green. They would not be in negative. It will show positive. But when you look at it over 3 or 5 years, then it will be returned. But what we do in FMAN is to ensure that houses or fund managers are investing in line with the trust deed, and they are not taking any bet outside the market. So they are not just doing anyhow. So that's the beauty of it, because again, we do monthly and quarterly returns and yearly returns to SEC, and they look at the asset allocation and ensure that it's in line with the trust deed. The trustee are there as well to guide and to ensure. So it's a reflection of the market. I'm not sure any fund manager would be happy to give negative return to investors, but so far it is in line with the asset allocation, and it's in line with what is stated in the trust deed. Then if it's the market that is making it to return negative, expectation is that market will turn. If it's a market, if it's equity that is giving return and it's an equity fund, you can't say you are not going to do it. You will still remain in that equity fund, right? And so what we ensure, or what would advocate, is that fund managers are always at the top of their game, ensuring that they give the best they can to investors. Thank you.
Thank you so much. My next question will go to Audrey Ogini. Of course, it has to do with some of your presentation too, but I want her to answer the question.
No, I can't hear the question. Sorry, please, can you take the question again?
Okay, no problem. Actually, why presenting a paper, she actually talked about different classes of funds. We have balanced funds, we have equity funds, we have bond funds, we have fixed income funds. So as an investor, how do I know the class of investments I'm supposed to invest in? How do I know the class of funds I'm supposed to invest in? What class of funds do you think an investor should be thinking of investing his or her money in?
Thank you very much, Tony, for that question. Very interesting question. And I think that's the foundation of investment, whether you're investing in mutual funds or you're investing in any other financial product. I think the key is to understand the investor's profile in terms of what is he expecting in terms of return, what is his risk profile. So a client or an investor is largely centered around understanding the client. So if you understand the client has a long-term perspective, but is also looking for an above average return, definitely you will not be recommending a money market fund, which are basically short-term funds. So your focus will probably be looking at maybe an equity type fund or a fixed income fund. Now, if he's an investor who has a long-term horizon and is willing to take risk, you probably recommend a fixed income fund, an equity fund, not necessarily for the investor to put in all his investment into that fund, but at least a significant portion of his portfolio can be in the equity fund because he has a long-term horizon and he's definitely looking for an above average market return. Now, another key profile of behavior is what is his attitude towards return? What is his attitude towards risk? If you look at the presentation by the professor talks about the fact that 49% of the mutual funds portfolio is invested in money market, because what that says to us is that the general market really is low risk, is looking for maybe fixed return, without taking significant risk. So in creating products also, you will look at, how do we ensure that this product, the risk is very low, and at the same time, we can be able to generate a significant return for investors. But I think that for the mutual funds industry to really grow, we need to look at diversifying from just looking at low risk investment products. Investors really want to take risk, but at the same time, they want that guarantee that that risk that they take is going to provide them significant or competitive return, which is why you see a number of these fintech come in and enticing investors to come and play in the foreign markets, with their platform. Investors know that even with the foreign market equity investment, they are going to lose their capital. But at the same time, they also believe that it's an additional way to generate more return than probably what demanding the client, understanding the investor, and aligning their preference for risk with their preference for return. Thank you very much.
Person. So I think that's what should guide the kind of investment you should, as in the type of funds you should invest your money in. Thanks so much. But there is that appears to be trending right now, and that's ETFs. I don't know, can you shed more lights on it? How does it work?
All right, thank you very much. So I think ETF is not significantly different from the mutual funds, apart from the fact that both fund structure pool investment together, to create options for investors. But for ETFs trade frequently. Client, this is the NAV as of today. When they invest, ETF is like a mutual fund that trades like shares on the Nigerian Stock Exchange. So they have prices that are generated at different points in time in a particular day. But the general structure of both the ETF is that it also pulls funds together and invest in various asset classes in order to provide diversification for investors and provide competitive returns for investors. I think if you look at the general market today in Nigeria, ETF has not really grown significantly. It accounts probably for about 1% of the total 1.5 trillion NAV of the collective investment scheme. And this is largely because investors still don't understand, how ETF, the role of ETF basically in their portfolio structure. I think as fund managers, we are trying as much as possible to create awareness about the ETF structure. But I think it's still the general appetite for mutual funds ETF that is also affecting the ETF structure. But I think to a large extent, going forward, we begin to see more traction for ETFs, particularly for ETFs that are not they are not dependent on the traditional asset classes like money market, fixed income fund. Last year, we saw the ETF that is linked to the to gold commodity increase significantly. Because of the nature of the environment, people are looking for better return compared to what the traditional bonds, fixed income, and equities are doing. So I think going forward, when we begin to create ETFs that are tied to commodities or tied to asset classes that are completely different, from the traditional bonds, and we'll probably begin to see more traction in that space. But the general structure of ETFs is largely not different from the mutual fund structure, other than the fact that it trades actively at different points in time in the particular day.
Thank you so much. Thank you so much. We're going straight to the next session. The next session is I'll be focusing on Dele Ige. But that session is sponsored, is brought to us by Ancoria Asset Management. Ancoria Asset Management. Okay. The essence of having this program is to actually dwell on, to ask ourselves, year 2020 was somehow for everybody, for all investors worldwide. Year 2020 was somehow. But the question is, what does this year hold? So Dele Ige was doing a message on the equity markets, 2020 equity funds recap and 2021 outlook.
Okay, so thank you very much for that question. I'll start by highlighting the performance of the equities market in 2020. The market closed the year up 50% in terms of the NSE ASI, and market capitalization went up by about 62%. Of course, the difference between the ASI growth and the market capitalization growth can be alluded to the listing of some major telecoms players, including I think MTN and Airtel, within that period. What you find in terms of performance through 2020, the year opened. I mean, the first month there was a rally in January of 2020. The stock market went up by about 7.5%. And then it started to correct in February and March. And then in April, just as the lockdown was in place, I think what happened in March was because of the lockdown, people started to exit the market because, there was thought that this is the doomsday and all of that. And then in April, some people started to see opportunities in the market and they started to take positions. So April, the market was up. May, the market was up. When we got to June, people took profit. And then from July, you see that the market started to ascend up till the end of the year. So most of the growth that you see in the stock market in 2020 started from about July, and then the market continued through the rest of the year. Some of the things that you will also notice in the stock market in 2020 is that domestic participation in the market increased in terms of volume rather than before, when we saw a higher foreign participation in the market. So you find out that, look, the total transactions improved by about 5%, and then total domestic transaction increased by about 35%, basically due to pension funds taking more positions in the equities market. And then foreign transactions fell by 25% in the same period. I think some of the reasons for that might be the concern for devaluation of the Naira, people, and then the scarcity of dollars that ensued because of people trying to rush out of the local currency. And of course, foreign inflow declined by about 43% within the period. When you look at the different indexes on the stock market within that period, you find out that the industrial goods index was a top performer in 2020, going up by about 90%. The NSE Premium Index, which are some of the top blue chip stocks on the exchange listed, and it went up by about 64%. And then you can begin to talk of the insurance index, the Lotus index, and some of the other indexes. For 2020, the stock that was a top gainer was NIMET, which is a pharmaceutical concern. It gained about 259 percentage points through the year. And then you find FTN Cocoa, Airtel Africa, which also went up by almost 200% within the period. Of course, what is the outlook for 2021? I mean, we expect that in the banking sector, there will be a slight increase in interest income due to higher loan to deposit ratio, an increase in non-performing loans, and slowdown in banks' non-interest income as well. CBN may also introduce new capital requirements. banks, especially for the banks in the lower tier. In terms of in the consumer goods sector, we expect that there will be improved revenue, which will be driven by higher prices, a slight decline in demand due to weak purchasing power of consumers. So yes, revenue may go up, but might not translate into profitability. Of course, that is also due to the fact that higher costs of inputs will ensue, because first, the Naira, has lost some value, and that will go into the production input costs. And then major players in various sub-segments to continue to struggle in 2021 due to a high competition. In the cement sector, we expect slight increase in cement demand in Nigeria and other African countries, improved cement prices due to higher manufacturing costs. So the prices should really go up a bit because of the cost of manufacturing, higher cement export as a result of opening of our land borders, ATCA and all of that, and then strong competition. And you find out that yes, Dangote is a leading brand, but I'm sure Lafarge is making its own efforts to try and gain more of the market share, and the competition is expected to be stronger in the current year. And government is to use more cement in road construction. So for instance, if you drive on the Bagada-Oshodi Expressway, you find that that stretch of road is now done with concrete, and more roads are going to be done that way. So it portends more business for the cement manufacturers in Nigeria. So in general, we expect impressive performance in the stock market, say up to half year. With what is going on in the market, fixed income market recovering, you might see some slowdown. And I mean, it's not that you might see, you've already seen some slowdown. The market is testing its positions to see where it will rest and all of that. And people are basically just taking profit from gains that they've made in past, and they just want to be in a safe territory. What you find in Nigeria is people are very cautious of the volatility of the equities market, which is part of the things that account for low patronage to equity funds in the market. You find that when you do a segmentation of the different classes of the different classes of funds in the market, you find patronage is higher on the side of money market funds, but very low when it comes to equity funds because of the fear of volatility in that segment of the market. So I think from here, I think we'll pause there, and I think we can pause there. That will be our own outlook of what the market should do in 2021, and of course what had happened in the market in the 2020 period. So I wanted to say a big thank you, and over to you, Antony. Antony, over to you. Okay, so I'm learning now that Antony has network issues. I guess we'll wait for his next call. Probably there'll be questions that follow. Hello, Antony. So I'm done. I don't know if you got to see what I was presenting. You need to unmute your mic.
Okay, thanks so much. Because of my network, I actually didn't pick everything you said. But I would like to ask, as someone that wants to, sorry, am I live? Am I in?
Yes.
Okay.
Yes, we can hear you and we can
as
see
someone
you.
that is probably planning to invest in, okay, you can hear me. Okay, that's fine. What are the things you expect any investor that is planning to invest in equity funds? What are those things you expect that investors to consider before making a decision?
Okay, so first of all, when you're investing in the equities market, first you need to select the stocks or the securities you want to invest in, or you should have an idea of the securities that you intend to. Please hold on. I have. Sorry. There was something interrupting my presentation. So yes, I was saying that if you're investing in the equities market, the first thing you look at is what kind of securities do you want to invest in, and you're likely going to be looking at that from a business investing perspective. And when I say business investing perspective, you're looking at the securities and the long-term prospect of that security. And then if you have done your analysis and you're confident that I can put my 1 billion or 1 naira in this security, then I can go all the way and put 100 million or more in that. And of course, when you're also doing that, you're looking at how long can I afford to stay in this investment. Aside from that, you're looking at it from the point of view that, look, if it doesn't go my way, can I hold out till when the market turns and turns to reward me? So you're looking at it from that perspective, not from the perspective of everybody's buying it and I am also buying it. You don't know what drives their decisions to buy. And you shouldn't really follow herd mentality in investing. You should make your analysis, and then you should be sure that, look, this is my level of expected returns. And again, when you set a level of expected returns for yourself, once you hit that mark, you should be disciplined enough to exit at that point. Otherwise, yes, sometimes you feel that you've exited and then the market continues to go on. But the fact remains that the market could also not continue to go on the way after you've exited, and it could turn around. So basically, the thing is to be disciplined when you're investing in a stock market. So you know what you want to get into. You have set your returns benchmark. Once you hit that benchmark, you should be ready to exit that position, and then wait for an opportune time to get into the market or into that particular position again. Thank you very much, Anthony.
And Anthony, can I come in?
Please go ahead, sir.
Oh, okay. So thank you very much, Mr. Ige. I heard you talk about NIMET, ramping up 259%.
Yes, sir.
And I understand there's a way that investors, especially those uneducated investors in quotes, who put this pool of funds together that you experts manage, don't have enough information, so there's a herd mentality, going into what you call, so there's large caps, there are large caps companies, on the stock market that the results are often the ones that media people report, and whatever happened with large caps, that's where the attention is focused on. Meanwhile, there are some gains to be had with the small caps companies. You have just talked about NIMET. I would doubt if there was a lot of information or news going out in the media last year concerning NIMET. So how do these small investors, uneducated in quote, who don't have the sophistication that you have just talked about, how do they begin to understand that there is something to be gained, looking at small caps and perhaps mid caps companies in the equities market?
Okay, if I'm to speak to that, I would just go ahead and summarize that is the reason why you have fund managers in the business. like you have described, the class of investors who are not highly sophisticated would need someone who has a level of sophistication to be able to read the markets and to be able to determine where funds should go. And I would rather advise that investors who fall into that category patronize fund managers rather than attempting to go it on their own. Because the kind of setup that a fund manager will have in terms of research backing, in terms of research capacity to be able to look at the markets, an ordinary investor would not have that. And what you find is most ordinary investors invest on the basis of hearsay. Oh, it's NEMAT that is going up now, so everybody rushes to NEMAT. Some might not realize that at the point at which they're heading into that investment, it doesn't make any sense again to go into that kind of investment because the rally is over. But they still go ahead anyway, and then they wonder, why am I losing money when everyone else is making money? So I wouldn't really advise unsophisticated investors to go on their own. If you're sophisticated enough, then you can, but if you're not, rather patronize a fund manager who has that sophistication. And of course, that's our business. That's what we do 247. That's why we set up shop, to be able to provide this kind of advisory. And what you find in advanced markets is that mutual funds are the general way of investing for the unsophisticated investor. It's only in Nigeria that you find investors trying to go it on their own, which is why you find a lot of people get bitten in the market. Thank you. Mr. Philip?
Satisfied with the question, or maybe he has another question.
Yes, but I can't hear him.
Philip, are you? Okay.
Well, just saying thank you very much for what you have just provided in terms of answers to that question. Again, 2021 is just March. We're in March, and there's still a long way to go. We haven't seen the budget actually play out, immensely, starting the year. What we want to have because you are steeped in this equities in this space, equity space. What do you think the market actually holds, especially that with the equities market? What does it hold in terms for investors, both small and non-sophisticated and the sophisticated ones? Looking into the year, especially coming from the backdrop of. Recall that in 2020 you had the money market rates providing some kind of information that made the capital market really boom. Now we are hearing a lot of things about to happen in that space. That might mean that there's going to be a shift. Back to the money market. Now the year is still young. So from your own perspective, looking ahead, for investors, what should they be looking at in terms of expectation from the equities market?
Okay, so let's look at this from this point of view. When you want to invest, you look at your opportunity costs. You understand? And when I say opportunity costs, you're trying to compare that. Look, if I invest in the equities market, what kind of returns am I missing in the money market or the fixed income market, which is something that you can identify by comparing your dividend yield to the returns in the money market or fixed income market, for instance. So for instance, if I were to get into a stock today that is paying a dividend yield of 4%, and the dividend is expected to come in about 12 months' time, and then I look at the 1-year T-bill rate, which is about 6% or 6.5% as we speak. It pays me to be where I get a higher level of return than my 4% in the equities market. You understand? But then it's not as simple as that. You might want to look at the future prospects of the company that you're investing in on the equities side to say that, okay, so probably you have a company going into a line of business, into a new line of business, every investment relating to that has been made. It's just for them to open that line of business, and then you expect that, look, the dividend yield and the earnings yield would increase significantly over the period. Then it might make sense. But of course, because attention to the equities market may have reduced because of what is happening in the fixed income market, you want to be sure that you're getting into your position at a very cheap price, so that eventually, at some point in the future, the market will turn. Which is why you also look at your capacity to stay in an investment for a long time. Say 2-3 years. Before you want to exit the position. But what I think in terms of the current year is that the equities market will see some corrections because of what is happening in the fixed income market. It's just general market sentiments. People prefer the safety of the fixed income market to the volatility of the equities market. So you can expect it that at some point in time you will see exit or flight from the equities market to the fixed income market. But that might tamper if you find that there is no expansion in yields in the money and fixed income market. If the expansion in yields, just stops at some point, people might want to consider. Based on the comparison I earlier said, that look, you want to compare your dividend yield to the kind of returns you can earn in the money market or in the fixed income market. So once you find that, look, you have an advantage, and then you can see some positions. I generally believe that some equities position will remain strong, regardless of what is going on in the fixed income market. And when you look at what is happening in the fixed income markets now, who do you think will benefit the most? I think the banking sector will benefit the most. They're the ones who play the most in the fixed income market. So regardless of anything that is happening, those stocks should be looked at critically, and then you can consider your investments and make your own decisions. Thank you.
Thank you, Tony. You can
Okay,
return to
thanks
you.
so much, Philip. Thanks so much for interesting questions. Before I let Gay go, I would like to ask, what mistake do you think investors make most? Investors that want to invest in equity market, from your experience, what mistakes do you think they commonly make?
Well, it's simply put, it's a mistake of herd mentality. Everybody, once you see everybody buying it, or once you see at the point when you see the share price moving up, you think it's the right time to buy. Whereas you could have done your analysis and invested when the share price is particularly at an ebb, and then you ride the rally, to when it is up. And then the other mistake is that people do not realize when to stop. There's always the assumption that even though I had bought at an ebb, it is at a crest now, I should exit, but they assume that it will continue to grow. And so they don't get out, and then all the gains made just evaporates one day like that. And what you find is you really don't make profit in the equities market unless you realize whatever capital gains you've made. It's not profit. It's just virtual money if you haven't realized it. Thank you.
Thanks so much. This question I'm going to ask all the panelists. And what 5 stocks do you think people should watch out for this year? 5 company stocks that you think people should watch out there. He's still talking. Delege.
Oh, you want me to start?
I'm starting with Delege. I'm starting with you, yes. I'm starting with you.
Okay. I really don't like giving stock picks, but well, since you've asked, I would I would oblige you. One should consider a stock like Zenith Bank, consider Vitafoam, Access Bank, Lafarge, Dangote Cement as well. But of course, you need to watch out for the price at which you enter those positions. That would be my advice. Thank you.
Please let me know when it stops.
I'm done. Thank you.
Sorry, I lost you because of my internet. Can you please help me to take it again? Quickly.
Okay. So I started by saying that I normally would not like to give stock picks, but because you have asked, I will oblige. Yeah. And I penned down 5 stocks here. Zenith Bank. The performance has been really good, even in a pandemic year, and I believe they have capacity to continue to deliver very superior returns. Vitafoam has been a stock that has performed well, and I also know that they're going into a new line of business, which is expected to open within this current financial period. That should add to their top and bottom lines. Let's look at Access Bank, Lafarge Cement, and Dangote Cement. Of course, the cement companies, due to the fact that in Nigeria now we're cutting over to having concrete roads rather than asphalt roads. So you should see a lot more patronage for those cement manufacturers. Thank you. So Anthony, I think his connection is...
You and him can do that.
Anthony, so over to you.
Don't worry. But you can tell him, chat him. Okay, thanks so much. I'm going straight to Odiri. I would like to ask you the same questions. What do you think people should watch out for in 2021?
All right, interesting question. So I'll be a bit sentimental here. So United Capital stocks, I think people should watch out for it. As of March last year, the stock price was trading at 2 naira. It closed the year 2020 at about 6 naira. The company paid about 70 kobo dividend. The price is still about 5 naira now. Probably after the adjustment of the dividend, which was done earlier in the week, it traded down to about 5 naira. So investors should watch out for the stock because definitely it will improve significantly. And then I will also say UBA, even though their dividend payout was a bit conservative, definitely investors will probably trade down the stocks, on the back of the fact that the dividend wasn't great. So it will be a good opportunity for investors to enter at a lower price, and ride it up because definitely their performance will be sustained in 2021 and going forward. I will also say Zenith Bank, they've been resilient irrespective of the economy. They keep coming out with good dividends, and then the performance also is very impressive. MTN is also a stock to watch out for, and then Access Bank also a good stock to watch out for. Thank you very much.
When she's down. Okay, thanks so much. Because of the connecting, because of the event publication, we intend to include those details, those items in the publication. Thank you. Then, Ifeoluwa Dixon, I'm sure you must have been waiting for the questions.
On the same stock picks. Hello, Anthony. Hi, Philip. Is it the same question that Anthony would want me to address?
I assume his question would be, what are your 5 stocks that you would?
5 stocks. Okay.
Yes.
So if you want to go by industry, I like going by industry first. And so it will be telcos, construction, which is industrial, and then the banking sector. So I'll go with MTN, I'll go with BUA, I'll go with Okomu, I'll touch on GTB and Zenith. So those are my own 5 stocks.
Questions before we leave this session? Philip, are you there?
Okay.
To leave the equity market and move to the next session, but I don't know whether you still have any questions to ask them.
Yes, thank you very much. You can hear me, right?
Yes, I can hear you.
Okay, yeah, thank you very much to all the panelists, to Mr. Ege, to Ifeoluwa, to Odiri. It's an interesting market, especially when you look at fund management and how there is perhaps some kind of disconnect between you experts who are sophisticated in terms of how you deal with you handle the funds that are in your custody, But can we get across the panelists? Can we have a sense of growth, within the industry? By that I mean individual by individual key players, in the funds management space in the country. How do you project at the end of the year? Looking forward to the coming year, as we look into 2021, the type of growth that you individually will be expecting from the funds that you manage.
Okay. Okay. I don't know. Can you direct your question to a particular panelist?
Okay. If anyone, you can take that first.
So if I hear you well, Philip, right, you want to know the growth projection.
Yes.
That's
yes.
my own house.
Yeah, your own house.
Based on my own house. So it's a function of the market itself and the strategic growth the business on its own wants to achieve. So it's not in all years that you want to go all out bullish. Some years you just want to, to reset. Some years you just want to reimagine the things. Some years you just want to be, audacious, bold, agile, and the likes like that. And so that is what will then determine the kind of growth rate you want to give to the funds you want to manage. Everybody wants to be top 3, right? And so is that kind of metrics you want to see across. It will be difficult to say I want a 20% or 50% growth, but you want to give the challenge, and I want to believe largely even for the industry as well, to say, okay, I want to be top 3, I want to be number 2, I want to be number 1. And then maybe the ones at the lower end of the ladder maybe saying, okay, I want to be number 10. I want to be part of the top 10 across all funds that I'm managing, or as a total, when we look at the league table by SEC, I want to be number 10, I want to be number 3, I want to be number 1 or number 2, rather than us sitting with a growth rate of saying 25%. 25% might not be nothing really, So is that league table that we watch out for. And then, it's based on that we then infer the kind of growth rate. So your growth rate really might be 100% if you need to cross into the next band, like 100%. So that's the way we view it.
The same to Odiri.
All right, thank you, Philip, for that question. And bringing it home to United Capital Asset Management, I think is a function of what the business is looking at a broader strategic level. Last year, or in the last 2 years, we focused heavily on driving the growth of the mutual funds. We started 2020 at about 39 billion, roughly about 39 billion. We closed 2020 at about 162 billion. And yes, it's also a function of the market, but we saw in 2020, investors were shifting from money market funds because the returns trended low, in line with the treasury bill market, and then they shifted significantly to fixed income funds. So even us, we had to reposition, because as at 2019 October, our fixed income fund was about 500 million. We grew that to almost 120 billion at the end of last year. So yes, the market plays a great factor in the process, but as fund managers, as business leaders, what we see is how do we position ourselves, in terms of our fund also to attract some of these flows. This year, we've seen market continue to rise, and we've seen that definitely money market fund is probably not the way to go, because, the yields are still very low for short-term instrument. And then we need to also position ourselves if we have to create new products in the fixed income fund space, or to take advantage of returns that are more attractive, because basically that's what investors are looking for. As a business leader, we will have to do that, because we need to attract more flows into the fund, to be able to take us to grow to a certain level. This year, we started at 162. As at end of February, we are currently almost 190 billion. So we've seen already a 17% growth in 2 months. So as a business leader, you project that to end of the year. If you can sustain this, probably will get to a much higher mark in terms of the growth of the funds for the business at the end of the year. Thank you very much.
And if Dele is still there?
Yes, I'm still here.
You want to weigh in on this, because the reason why I'm asking is that you can see fund managers, who want to grow the what you call fund under management, but the key thing is about the investor or the investors out there. That's why I'm asking this question. You guys who want to grow the portfolio that you have, you grow assets under management, but what the returns, in Europe, in America, you can take a bet and you can see fund managers tell you that we provide return of 25% or 30% or even less, but you guys are not bullish in this market when you deal with investors, are you?
Okay, so let me try and give you a response to that. Our growth projections, first of all, has to do with the asset class that we're investing in. So for instance, you would not expect us, yes, we're not even allowed by the SEC to promise and to guarantee any kind of return, however little, to the investors. But in a market, in a fixed income market that is not going beyond 5-6%, you do not expect us to promise anything higher than that, or to project, rather, I think that's the appropriate word, to project anything higher than what the market is doing. Otherwise, we'll be forced to do to take decisions that are out of our eligible investments and all of that. You should also understand that for collective investment schemes, most of the investments we make are in traditional asset classes. Now, the only asset class that can likely give you a kind of inflation-beating return is the equities market. You understand? Fixed income market, money markets, they're about the same asset class, and the returns may not be as fantastic as that. Now, when you want to get into the space where you need to deliver the kind of returns that beat inflation, you need to be talking of non-traditional asset classes, where you begin to talk of commodities and stuff like that. But of course, I believe we're getting there as fund managers. We're not yet big on the alternative space yet, I believe largely it's a developing segment within the market. But of course, when we get to that stage, then we can begin to promise those kind of returns. And I also need to sound a note that, look, if you're promising a certain kind of returns, then you probably are not dealing with the general, the investing public, as they say. You probably are dealing with sophisticated investors, or who they call the class of investors they call qualified investors. Now, when you're talking about qualified investors, you can go ahead and promise them, a level of return. And of course, that will determine whatever incentive you get afterwards for delivering that return. But in the space where we operate, because the investments are traditional investments, we're not allowed to first, promise those kind of very enticing returns, if you like. So for us, when we're looking at projections for returns, the indices we look at look what kind of returns do we want to deliver. You understand, on this fund, within the space, you understand. And then we look at the volume growth that we're targeting. We look at maybe the year's budget, for instance, and see, look, what do you project in terms of disposable income for investors in this given year? I mean, in a year where you find inflation has gone up and the salaries, the incomes of people have remained the same, it means that there will be less disposable income. You can't really project significant growth in terms of volume. But the volume growth is a different thing when you start to look at the return growth. That you begin to look at, what do I see in this market? I would like to stop there. I hope I have successfully answered this question. Thank you, Philip and Anthony.
Thanks so much. I think we've dwelled enough on the equity markets. I want us to go to the next session. Thank you. Thank you, Delege. Thank you, Odiri. And thank you, Dixon. Now we're going to the fixed income market. We want to look at how the market was last year and what we're expecting this year. And that session will be taken by Dixon. That session will be taken by Ifeoluwa Dixon. And the session is brought to us, it's sponsored by United Capital Asset Management. Thank you. Dixon, you're going to help us to do a recap on the 2020 fixed income funds and our 2021 outlook. What should the investor be expecting from the fixed income funds in 2021? How was the market in 2020, despite all the COVID challenges and all that?
Thank you, Anthony. So let me even start by giving just the background about what fixed income instrument is, just for the investing public and not for the expertise or the people that are here who understand, or who knows. Somebody might just be asking, so what's fixed income? They're kind of debt instruments, right? And they are largely being issued by corporate or government. Government could be federal government or state governments as well. And fixed income, just like the word is, or the name is fixed, gives fixed periodic interest returns or payments to investors, right? So it's more of somebody has come, an issuer has come to say, I need money, debt, you're borrowing, and then you are the lender. And there is expectation that at the end of it, I will get my principal back, and in between, you pay me interest. What we tend to have in Nigeria is coupons are being paid twice in a year, biannual. In some jurisdictions, it could be 4 times, which is every quarter. And some instruments could even be at the end of the period or yearly that coupons will be paid. So having laid that foundation as to what fixed instruments are, or what fixed income assets are really, and it tends to give a capital preservation. So when we look at it from that angle, and then I will now touch on how how the pandemic has affected this asset class. For me, right, I wouldn't say in Nigeria that what we saw last year was as a result of the pandemic itself. I'd say it's more of policy driven, and the body language from the CBN and the DMO, Debt Management Office, about them saying they just want to keep interest rates low, and that's to lower the to lower returns or to lower the debt servicing. Yes, you know, the rate at which the federal government was using, how much the federal government was using to service the debt. And so that was the major focus, which in a way, because DMO did like another 3 to 5 years medium term expectations, and could see that they achieved what they set out to achieve for last year, 2019 and 2020 anyways. And so that was what happened in our market, not as a result of pandemic. Pandemic, maybe 20% really. And so because it was more of policy driven, we saw rates nose diving. You know, DMO would come and would just issue T-bills at 0.1, the longer end. The reaction will be seen in the market immediately, and people trying to either buy or to just get out of it. The same thing happened in the bond market as well, where rates too was equally low. Not because people were selling to hold on to cash, but again, another thing that happened last year was, if you take a cue from what happened in October 2019, when CBN came out, and so I said more of policy driven really. CBN came out and stopped local investors from participating in the OMO window, which is the open market operations. Now, those investors, local investors, PFAs and the fund managers like ours itself, that have locked into the OMO bills, you know, prior to that announcement, a 1 year largely, had to hold on to the instrument till the end of 2020, not end, by that same October 2020. And so last year again, largely what was driving the market was liquidity. So much of these OMO maturities were maturing into the system. Local investors couldn't participate in the OMO that is being offered. And so it was more of liquidity chasing the same asset class, which is bonds anyway. And so we saw the demand pressure going on as OMO maturities were coming in, people trying to go into the secondary market, yields were nosediving, DMO was having their own party, and even at the primary auction as well, they were just dropping rates on a regular basis for local investors. Whereas on the OMO space, up until towards the end of last year, they were still maintaining decent levels. And so that was what we saw in the space. And because rates were nosediving, people were no longer interested in holding 1 year bills at 0.1. You know, we're just moving into the equity as well, because the depth of our market is still not that deep. And so if you're not doing bonds and T-bills, you'll be doing equities. But like, you know, another speaker has mentioned on this call that the next thing is alternative investment space that people are moving into. So that's what happened in 2020, where we saw the pandemic, you know, and it was a random fixed income assets movements, you know, people just cherry picking, let me pick this. And I have cash, I need to invest. What can I invest in other than bonds or T-bills or equity? If my risk appetite can't take equities, then I don't have any other option than to stay in the bond market. And for the bond fund or the money market fund, no other option than to do what the bond yields were offering to us. And so that is what happened last year. And so yields declined just because of liquidity, and policy statement as well drove that down. Expectation into 2021 again, we've seen it, the body language has changed from CBN and DMO. CBN trying to defend the Naira by all means and doing all sorts. The DMO as well, the federal government needs to borrow on the physical side, and you need to borrow. Investors have the cash, they are not willing to take your 2% or 1%. I've started seeing the gradual movement again, moving north, in the yield space. The last auction that held yesterday, the results came out on the 1 year, 6.5, and it's been jumping like that, which is like 100 basis points change from where it was the last one, which was at 5.5. And so we could see that desperation again are setting for the government to come and borrow. And the people holding the cash are saying, but I'm not willing to take it at this low rate. And so people are bidding at the high end of the market. And so that is what is going on at the moment, because we need to borrow based on the budget that we've seen and what DMO has set out again to achieve in terms of, the mix from foreign borrowing and the local borrowings as well. We've seen the mix. And so more of it will have to come from the PFAs and fund managers like us. And so the fund manager is saying, but I can't do it at 0.1. It has to be at this when they are submitting bid. And we've started seeing it moving up again. And again, because the liquidity we saw last year is no longer in existence. Last year, like I said, OMO maturities, a lot of liquidity. We are not seeing such liquidity again in the system. And so there is no huge liquidity. If there is no excess liquidity, the yields will need to give way for people to come in and invest. CBN trying to defend the currency, trying to do also to woo investors in. To has changed even in the OMO space. They've increased the rate to the 10 levels. And so these are things that are going on. And, for a trader, a dealer, if I could get OMO at 1, or if I could get a 1-year Nigerian Treasury bill at 6.5, why should I buy a bond, a 3-year bond at 6.5, or a 3-year bond at 5? And so again, we'll see that reaction in the bond space, that the short to mid end of the curve as well will follow these northward movements that we've started seeing, because the bond market over time has been muted in a way, trying to see, but with the last stop rate that we saw yesterday, definitely the short to mid end of the curve on the bond curve as well would move in line. Thank you.
Thanks so much, Dixon Ifeoluwa. I want to know, what advice do you have for any investors that is planning to invest in the fixed income market?
So before you can even say you want to invest in the fixed income market, you need to determine what your investments need. And this is what I do tell any of my unit holders. What are your investment needs, especially liquidity needs? Why are you investing? What's your time horizon? And then your risk appetite as well will determine what we're going into. And so these are critical things that we need to know. If you're investing in a bond fund is not like a money market whereby it's short time horizon. I showed the presentation the other time, I spoke about it the other time. To say money market time horizon is less than 1. For the bond fund is greater than 2. The mix is greater than 3. And so once you understand that that is the time horizon for you to come and to be made whole, or to come out clean and to have good returns to show for it, you must be willing to wait for it as well. And I'm speaking as mutual funds and not you going in as an individual into the bond market directly. And so the bond fund, because you have so many other bonds into it with different duration, different time horizon, different interest rates, right? You need to weigh it out. And so it's the duration of the average duration of the fund that determines, and that's the advice I would give. What's your time horizon? If your time horizon is 6 months, don't come into the bond fund. It's not for it. Just go straight into the money market. If your time horizon is 3 months, don't come in. But if you're saying your time horizon is greater than 1, then I can advise. If your time horizon is greater than 2, then I can tell you that the bond fund is good for you. So 3 things you need to know. The liquidity need. Is it that you want to put it in today and tomorrow you would come and ask for it? No, the money market will be good for you. If you're saying, I can actually weigh it out, 2 to 3 years, then the bond fund is good for you. What's your risk appetite? Yes, we do say that capital is being preserved, but you should understand as well that there are, for those that would mark to market, for those that value their bond position using the fair value methodology, then capital most likely may not be protected. But if you're doing amortization, then capital can be preserved. And so these are things I would advise investors to know before jumping into a bond fund. Thank you.
Thank you. And what mistakes do you think investment, as in investors that want to invest in fixed market funds, what mistakes do you think they make most often from experience?
One that easily come to mind is not knowing the characteristics of how a bond fund works or how a bond market works, right? Because yes, how it works. That's one thing that comes to my mind easily, because you know they just assume I will be made whole. But like I said, the valuation methodology is not amortization. You may not be made whole. You may not come out clean. And so you need to understand what's the valuation methodology, what's the time horizon. So understanding, and the part on the fund manager is to educate as well, to ensure that there is a proper understanding of what the investor is buying.
Thank you. The next question is to Odiri Ogini. And the question is, what do you think investors should consider in selecting a fund manager? What factors do you think they should consider before even selecting or deciding on a fund manager to manage their funds for them?
Thank you very much, Anthony. Interesting question, I would say, because that's the basis or foundation for investing in any mutual fund product. So for an investor, the first thing to consider is look at the history of the fund management company or the fund management house that you want to engage. Now, in the presentation from FMAN, she spoke largely on the fund manager being licensed. You know, you must be registered with the SEC. You know, so looking at the history, in reviewing the history of the fund manager, you must ensure that he's registered, he's a registered portfolio manager, you know, registered to collect funds, registered to create products, you know, and manage those funds. So the history of the fund manager is important. History in terms of alignment with the regulator. Now, in also looking at the history, look at the history of performance. You know, this fund management company has been managing funds for over 10 years. How are those funds been performing? Whether it's money market fund or fixed income fund or dollar funds or even the equity funds, what's the performance of those funds that are being managed by this fund management company? Now, for a fund management company that has been outperforming the market and have been doing well in terms of performance, it's probably a good place to start. Now, for fund managers who have not been performing well in terms of their funds, you probably move on, you know, and look for other fund managers that are doing well. So for me, the first thing is ensure that the fund manager is registered with the SEC, regulator-wise, they are aligned. And then in terms of performance of those funds, it's also a good place to start. Now, I will also add that look at the size of the funds that are being managed by fund management companies. You know, they are top 3, top 5, or probably even top 10. You know, for me, that's a signal that that company is actually doing something right. You know, it means that other investors are also dealing with that fund management company. So for me, the size of the funds that are being managed by the fund management company is also a place for investors to look at to decide whether they can go with this fund management company or not. So 3 things: ensure that the fund management company is registered with the SEC, ensure that the performance history of performance has been good, and then ensure that the size of the fund being managed by the fund manager is also significant enough, you know, for you to be willing to commit your funds to that fund management company. Thank you very much.
Yeah, thanks so much. Sorry, before I let you go, talking about the asset under management, that's the size of the fund under a fund manager. What happens when a fund manager has a huge assets under management, but the performance is not good, and a company has small value of assets under management, but they have very good performances? Which one would you go for if you have to pick?
Right, interesting. But sometimes there can be a correlation between the performance in terms of return and the size. You know, but if a company has a small fund and they are doing well, it's possible that they can do well. So let me give an instance of a fixed income fund. You have a fixed income fund that you launched about 10 years ago. You know, it's currently 1 billion. As at that time, that was the size of your fund. The market was really the fixed income market was, the returns were very high. So you invested then. And 10 years after, you're still at 1 billion. Now, compared to another fund, definitely your return will be high for that fund because you have invested a long time and new funds have not diluted the return on that fund. Now, you compare same with a fund management company who has about 10 billion in asset under management for the same fixed income fund. As new funds are coming in to that fund, definitely he will have to reinvest into the current rate in the market, which might not be as high as what the other investors have been investing in. So if you look at that, you say, oh, let me go with this first fund management company because their return is probably 16%, even though their size is about 1 billion, compared to this one who is doing 10 billion in size, but their return is probably about 12%. You know, but the truth is the return of the first fund manager will also continue to dilute because it will begin to align to the market as new funds come into it, which is why I said in selecting, you don't just look at return or history, also look at the size of the fund, because if you have capacity to manage a large size of funds under management, definitely you will want to be competitive in terms of looking for outlets in order to be able to ensure that your returns are well, you know, for investors to keep coming. So both of them, we need to consider both of them, not necessarily one over the other, you know, because at the end of the day, the one who has a smaller portfolio, you know, as new funds begin to come in, it has to align with the direction of the market, and also the return will definitely begin to dilute. But for the one with the large fund, you already know at this point in time, his return is still very competitive, even though he has a large size. You know, so for me, I think investors should consider both, not one over the other.
Yeah, thanks so much. But why researching these? Why researching award? Some of our consultants actually feels that in assessing the performance of a fund, that assets under management does not really matter when you're dealing with equity funds. Do you agree with them? That it matters with fixed income funds, but with equity, that it does not really matter. That performance, that any fund that can, and a fund that can manage a small size assets, equity asset very well, can as well manage very well a huge equity funds. Do you agree with them?
Well, that's a very dicey one. So I will not say yes or no, because you have to look at the dynamics of an equity fund. First of all, the equity funds have really not say that, yes, for equity fund, if you have a smaller portfolio, you know, it's easier for you to probably be doing well, you know, because a number of those stocks you have taken positions a long time, you know, and over time, you know, those funds begin to, those companies begin to do well, you know, in terms of their performance. So definitely it will also affect on the return of your equity portfolio compared to maybe equity fund manager who is at every point in time, money keeps coming, and then you have to invest in the markets. You know, as monies keep coming, you have to enter the market and invest. Probably at that point in time, the market is not the return on the market is not attractive. You know, the way the equity market flows is volatile. At a certain point, it's good. At other points, it's not good. So, but as a fund manager, when you have funds, you have to keep entering into the market at every point in time, because based on the trust deed, there's a certain percentage that you must always hold in equity. So for the equity portfolio manager who has a larger fund, that may be a reason, you know, why his performance is not is lagging behind if a fund that has a smaller, or a firm that has a smaller fund. But for equity fund, in terms of performance, I think the most important thing is, are you beating the benchmark? You know, so my equity fund might be returning 16%. Somebody's equity fund is returning 23%. But at the end of the day, the benchmark is basically 8%. So even at 16%, I'm also beating the benchmark. At 23%, the other fund manager is also beating the benchmark. So I will definitely look at the most important thing is ensure that as an equity fund manager, you are beating the market at all times.
Thanks so much. Delege. I hope Dele is still in the house.
Yes, I'm here.
Yeah, please, what's your take on that? What was your take?
So I'd like to say, first, I'll start from the point of view that thankfully the Securities and Exchange Commission has gone ahead to standardize benchmarks for fund managers to measure performance of one fund manager against another, and against, you know, the benchmark, of course. And I'd also like to add that, look, when you talk of equity funds, the same effort that goes into managing a large fund goes into managing a small fund. it's the same effort. You have to put in the same level of research. You have to be sure that, look, the stocks I'm getting into would earn returns. So, I mean, it's the same effort that goes into managing a large fund that goes into managing a small fund. Now, another thing you look at is, look, how long has a fund manager stayed in the market? You'll find out that with length of time in the fund in the mutual funds industry, fund managers are able to accumulate a larger asset under management. But it's not only due to the length of time. The other thing we find in Nigeria is the fact that when you have a fund manager who's related to a bank, they start to derive a lot of benefit from that kind of relationship, because they're like the offspring of a bank. There are relationships that enables or encourage the bank clients to patronize the fund manager, which an independent fund manager may not have. But let's not forget the same rules. Recently the Securities and Exchange Commission requested that we update our trust deeds for every fund, and they sort of with that new rule, they aligned a lot of the definitions and a lot of the benchmarks for the funds as in terms of asset allocation and all of that. So you find that we all play on the same field. You understand? We all play with the same rules, under the same rules. And then the same effort is put into whatever we do to ensure that we deliver returns. So for me, yes, she had, Odiri has responded as saying that, look, as a fund continues to grow, you have to invest in the same market. Which is fine. I mean, you have to align with the levels of the market at that point. But of course, what causes a differentiator is the fact that, look, what research do you bring to the table? What insight do you have that beats other fund managers that helps you to deliver better returns? So it's in the returns and in the benchmarks that you determine who is better in terms of managing the funds. I think that's all I have to say for now. Thank you.
Okay, yeah, thanks so much. Whether we like it or not, sometimes why analyzing the market, you actually have the challenge of deciding which fund house you consider to be a leader in the industry. Naturally, like in every facet of life, everybody wants to associate with the leaders.
Yes.
So, and of course, why researching? Because today we present awards, and we were faced with that challenge at the beginning of our research. But we just realized that for example, a fund management company, that's our Stanbic IBTC, controls more than 50% of the whole market. So now comparing Stanbic IBTC, for example, with I'm going to mention the Delegate's company, Park Asset Management. Yes. It might sound a little bit unfair, but at the same time, for our award category, that's why we try to have different categories based on assets under management. We have a platinum category and we have gold category. And the rationale for having such categories is simply because of their assets under management. We understand there are some fund managers with relatively small sizes of assets under management that are doing very well. We actually feel they should be appreciated. But at the same time, we believe that there are so many viewers watching us at home and so many viewers that will still see this video. And the question, one of the key questions on their mind is to invest, which fund house should I consider? Which fund house should I go to? So now, Dixon, we need your opinion on that. Selecting an ideal or the right fund manager to help manage my funds. What are the things you think I should consider in selecting the right asset manager for my assets? Ifeoluwa Dixon.
Yes, please. So, so I'm not repeating the same thing. I will just go in another route. So, in selecting, you want to check the track record, right, of the house.
Yeah.
You want to check the track record of the house. You want to then even if you have the resources, if you can then even know the managers, you know, the people behind what is being done as well. Yes, the portfolio manager. So people as well, aside performance, we want to know the track record of the people as well. Have they been consistent, you know, or is this just the one-off thing? So consistency as well, hence the track record matters. And you're not just picking 1 year, you're looking at it over 5 years, over 3 years. And you're saying that these people, in fact, you know, they know their onions and they are good at what they claim to do. And another thing which is big for me is transparency. Transparency,
Yes.
that a unit holder, transparency is key for me and even for us as a house, aside just being me. Transparency is key. You know, I'm being open to my unit holders for them to know my total expense ratio. I'm being open to my unit holders for them to know even open to my management fee, what I charge. I'm being open to them to know the valuation methodology that I'm using in valuing their performance. I'm being transparent enough to say, you know what, whatever return that I put out in the public is what you will get when you want to leave the fund today. And so not a case of I want to redeem and I'm hearing a different story of say, you know what, we then need to back out taxes, we need to back out some costs. And so really what we've published is gross or no. So, you know, that is another thing to say, what you see is what you get. So transparency as well is another thing that I would tell unit holders to always look out for when investing.
Yeah, thanks so much. I don't know whether Philip has any questions for them before we leave this session. And also for our viewers at home, if you have any questions, you can please send your questions in the chat box. You can send your questions in the chat box. We will take your questions.
Anthony, thank you very much. Thank you, panelists, for the incisive answers you've given to some of these questions. But what I've heard across the board is something that has been playing in the market for maybe decades, you know, in terms of what I call restrictions in terms of your ability, you know, to be bullish. Because I think I've heard that said by a couple of you, if not all three, you know. What can be done in terms of freeing up the space, you know, especially in terms of asset, areas that you can put money, I mean, you can invest in, you know, by whether the regulators or the authorities, whoever is responsible for this, you know, because I've seen some, you know, areas for investment is somehow limited. You know, what can be done, you know, to expand that space to allow you, the fund managers, to be perhaps conservatively bullish, if we put it that way?
Okay.
This across 23, yeah.
Okay, maybe the delegate start by maybe the delegate should start try answer as in she should try answering the question.
Okay, so I'll start by saying that like I said earlier, what collective investment schemes are all about, there are traditional investment, traditional asset classes, and you already have ready markets that determine the level of return. So the kind of returns you can generate depends on the kind of benchmark you are adopting. But what we do in PAC asset management, as aside from having collective investment schemes, is we have separately managed accounts arrangements with individuals, and you know, but individuals and institutionals that you know, with that kind of arrangement, you can promise some kind of returns that is superior to the market returns generally, and but you find that kind of space is not deeply regulated in Nigeria, unlike the collective investment segment. Now, because there is high regulation in the collective investment segment, it limits how much you can earn as a fund manager. It limits what you can do. So for instance, you have an asset allocation matrix, and you cannot play outside of that allocation matrix. And why can you not play, why can't you play outside of that matrix? You find out that on a regular basis, you have to deliver reports to the Securities and Exchange Commission. And if you're found violating, say, for instance, your asset allocation for an equities fund, for instance, you will be penalized at the end of the period. You understand? And I mean, because it is a regulated industry, there is a maximum you can make in terms of returns. But was asked by is it Anthony or Philip now, that look, what can you get into to, you understand? Basically, you can begin to look at the alternative investment space, and you can begin to, and that includes things like real estate, commodities. And for us in PAC Asset Management, that is where we see this going. We believe that, look, one can begin to marshal funds to the kind of investments that really create an impact on the society. What you find in an economy like South Africa is you find a lot of real estate development ongoing in that country, but a lot of them are tied to funds, to mutual funds, real estate investment trusts, schemes, and all of that, that help to build those things. And then people have fractional ownership of the funds or fractional ownership in the assets owned by the fund. So that would be my answer to your question. Thank you.
Okay. That is more or less the last response in that session. Because of our time, we will go to the last session, which is more of a fireside chat, and it's going to be directly with Ogini. And that session is being sponsored by Quantum Zenith Asset Management. Quantum Zenith Asset Management. Thank you. We realized that a lot of fund managers are actually creating funds in that are dollar denominated, dollar and euro denominated. So what opportunities are there for investment in US and euro denominated instruments compared to Naira denominated instruments?
All right, thank you very much, Anthony. So I'll probably just give you a brief overview of maybe why we are beginning to see dollar funds in the market. I think up to the first dollar fund was launched in 2017. And the premise for dollar funds is we're beginning to see investors just leave their dollar investment probably in the bank, or probably somewhere you have $1,000, what do I use it for? Probably just leaving your bank account, and it's eroding value because the banks will continue to charge you maybe interest on a monthly basis or management fee or something. And then you see that at the end of the year, the $1,000 has reduced significantly, or you probably keep it somewhere in your house, just locked up, because there's really no outlets to invest those funds. And the bank definitely will not take your $1,000 investment and give you any significant or any decent return. So in 2017, we began to see fund management companies set up dollar funds, either fixed, they call it fixed dollar fund or probably Eurobond fund. And again, for investors to actively play in the Eurobond market, to buy investment in Eurobond, whether FGN Eurobonds or corporate Eurobonds, you need a certain minimum of probably about $200,000 or $250,000, which the average investor or dollar investor doesn't have. And the nature of a mutual fund is definitely to pool resources together. So fund management companies saw the need to pool resources together in the dollar space now to take advantage of direct investment in Eurobonds, both across FGN and also in the corporate bond, which launched the idea of dollar Eurobond funds in the market. And we've seen a number of them between 2017 and now coming to the market. I think for investors, basically this is an opportunity for them to earn much more than what a bank deposit will give you, or much more than what you're leaving your dollar in savings account will give to you. The average return across the Eurobond funds market today is probably about 5%. So what we are saying is that an investor who has $1,000 or even as low as $500, you have the opportunity to earn a decent 5% or 6%, because this pooled funds are invested in Eurobonds. EcoBank issued Eurobond earlier in the year at about 7.125%. The average investor who has $5,000, $1,000 will not be able to access that kind of instrument. But with that structure of a mutual fund, that is investing in that instrument, you as an investor, your money is already there. You can also earn that decent return. So I think the idea generally is to use the mutual fund structure of a pooled option to be able to take advantage of asset classes like Eurobonds, where the average investor in its own individual capacity will not have access to. And this can be replicated across various instruments. We've stayed so long on the traditional side. I think the houses are beginning to operate, fund management operators are beginning to look out for other options where we can harness this mutual fund structure to be able to deploy those asset classes to investors.
Yeah, thanks so much. So we have a new president in the United States. So how do you think the policies and priorities of the new president will affect asset allocation and returns in all these foreign denominated mutual funds like US and Euro-denominated mutual funds? How would the policies and priorities of the new president affect returns in all these funds?
Okay, I think the summary is that Biden is a very conservative, and stable president. He has a stable perspective, where his policies are seen to be very stable, compared to the Trump administration. So to a large extent, the expectation is that the interest rate environment, the investment landscape, in the US and also in the international market to a large extent will be stable. So we believe that stability will be there as a result of the new president. And so we also need to create asset classes that can give us that flavor of investing in those markets because of the stability that we expect and that we will see at least in the next 4 years as a result of the policies, whatever policies that Biden will bring, administration will bring to bear.
Thanks so much. I think one of the key policies that people are expecting is the US return to the Paris Agreement on climate change. So how do you think US return to the Paris Agreement on climate change, how do you think it will impact investors' preferences in investing in all these US denominated and Euro denominated funds?
Okay, what I would say essentially is, I will still look at it from the perspective of who is driving that policy, because to a large extent, perception and investors' perception is driven around who is driving that policy and what is the nature of that person that is driving that policy. And from what we're seeing as a conservative person, as someone who likes to, bring together, let's come and discuss. His approach is a collective responsibility. Let's agree, let it be a win-win, rather than being radical. I think to a large extent, the most important thing for us, in looking at that market, in looking at investing in that market, is the stability that the nature of that president will bring to bear in his policy, in the agreements that he signed, in collaboration, which is a major focus of the administration. So for us as investors in that market, it's key for us. Stability, less volatility compared to what we saw in the Trump administration. Even in terms of the agreement, we also expect that there will be less volatility, there will be less radicalism. There will be more collaboration, more bringing everybody to the table to discuss, and agree and ensure that whatever we are doing is win-win for everyone at the end of the day. So for me, it's still the same thing with ensuring that there's stability in that environment for us to be able to invest and for investors to also look at investing in that environment.
Okay, lastly from me to you, what message do you have for your investors and potential investors in 2021? What should they be expecting from United Capital Asset Management?
Okay, so the expectation is that, for investors are becoming more savvy. They understand what is going on in the market. So my expectation is that they should align their risk appetite with the return environment. Interest rate is rising, in 2021 compared to what we saw in 2020, but investors are looking for much more. So you have investors who are saying, okay, even this 5-6% levels is still too low. I'm looking for something like 10%, you know, but they are also not willing to take that risk to be able to give them that 10% level. Because if you look at the equities market, there are a lot of companies that have done well. Their dividend yields have been very attractive. Even when you tell investors, okay, why you want this kind of return, you know, okay, why not invest in the equities market? They're afraid of risk. Oh no, I don't want to lose my capital. But so for me, the expectation for investors is trying as much as possible to align. Let there be an alignment between your return expectation as well as your willingness to take risk. You know, because the environment, the theory is the higher the risk, definitely the higher the return. You know, the lower the risk, definitely the lower the return. So for me, this year 2021 is more of return, aligning return expectation with the risk the investors are willing to take.
Thanks so much. What message do you have for your investors this year? What should they expect from you and from FBN Quest Asset Management? FBN Quest Asset Management. Dixon.
What investors should expect from FBN Quest Asset Management? Is that the question?
I said, what should your investors, what should people expect from your company in this 2021? What should your investors or your potential investors be expecting from you as a portfolio manager and from FBN Capital Asset Management, FBN Quest Asset Management?
So
what message do you have for them? What message of hope do you have for them? Yeah.
Message of hope will be boiled down to professionalism, right? Because we're SEC-regulated, again, I can't come out here to tell you we'll be expecting 10% or 5% from us, right? And so what I will tell you is professionalism. We should expect that from us. We should expect transparency from us. We should expect our customer experience to be great, to be beautiful, seamless, right? These are three things that easily come to my mind: professionalism, customer experience, the journey will be great, and also transparency from us.
Thank you. Delegate.
Yes, thank you, Anthony. Okay, for the PAC asset.
What message do you have for your
PAC asset?
I said, what? Okay.
So I heard the question.
What message do you have for investors?
Okay, so I heard the question,
okay,
and so I would say the consistency of returns. PAC Asset Management in the last year, equity fund was the best performing fund in the country at more than 55% returns. Our balance fund did quite well as well, with returns of more than 32%. Our Eurobond fund did about 6 or 7%. Money market fund, you know, when you accumulate the returns throughout last year, about 7%. So I expect that we will be able to be consistent in returns expectations for our investors this year. Yes, since inception, all our funds have consistently made distributions annually, and we expect to continue to do that. In fact, our Eurobond fund, which is in its first full financial period, has been able to distribute interim income within the period. And of course, we promise to continue personalized service to every investor with PAC Asset Management, and then to create more options for our investors to be able to diversify their investment options, to look into alternative investment classes for them. Thank you.
Thank you. Philip, I don't know whether you have any questions for them, and you take the closing remarks. We have 5-minute breaks, then we go to the presentation of the awards. Thank you. He's speaking already.
Yeah, to the panelists, I want to say thank you. Thank you to Odiri. Thank you to Dele. Thank you to Ifeoluwa. I mean, if you were to stretch this question and answer thing, there are so many areas, especially when you talk about what's called euro dollar denominated investment. And one particular question that will come to mind is that size is of essence, in terms of how our fund managers can play, in whether in Europe or America, in terms of investment. I was going to ask them, what they think can be done to ramp up fund size, that can come under management to really play significantly in Europe and America in terms of those foreign investment that we're talking about. If they have a minute or two, they can answer, but that's something that has always been on the minds of financial journalists, and especially when we have dealt with or when we have come across some fund managers who can be very dismissive in terms of the ability of local fund managers to really play big, outside the country. So thank you to everyone. Closing remark will be that we will continue to, Business AM will continue to lead the frontiers of financial journalism. We'll continue to dig deep into what fund managers are doing. We'll continue to provide a deep coverage for the activities and to look at how returns can be beneficial to small investors across the board anyway, small, medium, and large investors. That will be the closing remark, to say thank you and thank you again.
So thank you, Philip. Thank you, Ifeoluwa Dixon. Thank you, Delege. Thank you, Odiri. I'll take about 5 to 10 minutes break now. And when we come back, we shall be presenting awards to our winners. Thank you, and God bless. We are done with the stories. It remains the awards. We are at day. Yeah, thanks so much. It is time to our award winners. You know, while talking about award winners, it's a very sensitive issue because even while researching it, the questions that we deliberated on during the sessions actually came up because a number of companies that actually did very well in returns, in terms of returns on the, in terms of returns, we realized that their assets under their management, are relatively small when you compare them to some big houses. But at the same time, we still need to appreciate them. So in order to overcome that challenge, we decided to have different categories. For example, under Equities Manager of the Award, we have gold categories and platinum category. The platinum category is meant for those funds or funds houses that have huge assets under management. So we're going to start with Equities Manager of the Year gold categories. Equities Manager of the Year gold category. And our nominees are PAC Asset Management Limited. They are Pacam Equity Fund, AXA Mansard Investments Limited, they are Vantage Equity Income Fund, Ancoria Asset Management Limited, they are Ancoria Equity Fund. These are the nominees under Equity Asset Management Gold category. And the winner for that category is Pacam Equity Fund from PAC Asset Management Limited. We congratulate you for a job well done. We hope you continue to give good returns to your investors. Thank you. We go to the next category. The next category of awards that we are going to be presenting is the Equity Manager of the Year Platinum category. Equities Manager of the Year Platinum category. And our nominees for that categories are United Capital Asset Management Limited. Their United Capital Equity Fund did very well. Stanbic IBTC Asset Management Limited. Their Stanbic IBTC Nigeria Equity Fund did very well in that category. And I have to say something about Stanbic IBTC Management Limited. They control more than 50% of the whole market. So during our research, we realized that they showed up in almost all the categories we researched on. And then the third nominee in that category is First City Asset Management PLC for their Legacy Equity Fund. And the winner in that category is, United Capital Equity Fund from United Capital Asset Management Limited. They are the winner of our Equities Manager of the Year Platinum category. As mentioned earlier, we have these categories because of the assets under management. I'm expecting that to show on the slide. I want it to show on the slide before we move to the next category. So United Capital Asset Management, is the winner of the Equities Manager of the Year Platinum category. Thank you. Then we go to the next category of award called Multi-Asset Manager of the Year Gold category. Multi-Asset Manager of the Year Gold category. Actually, I have to say something about this category. All of them did very well. In fact, because of the performances of all these mutual funds, we have to create a list called honors list. They are all winners, but at the same time, we can't announce everyone as winners. ICO Capital Limited, their ICO Balanced Fund has consistently done very well in the market. Coronation Asset Management Limited too, the Coronation Balanced Fund has consistently been doing very well. Lead Asset Management Limited is very proud of their lead balanced fund. It's not just about them being proud of their balanced fund. The balanced fund did very well. But the winner in that category, our winner in that category is ICO Capital Limited, ICO Balanced Fund from ICO Capital Limited. ICO Balanced Fund from ICO Capital Limited is the winner of the Multi-Asset Manager of the Year Gold category. The next category is the Multi-Asset Manager of the Year Platinum category. When I say multi-asset, we're talking about balanced funds now, but I will leave that to the executive editor to take. Thank you.
Yeah, thank you very much, Anthony, for passing this over to me. The Platinum category, Multi-Asset Manager of the Year, we had the following nominees: FSDH Asset Management Limited for their Coral Growth Fund. Second nominee, FBN Capital Asset Management for their FBN Balanced Fund. The other nominee, Stanbic IBTC Asset Management for their Stanbic IBTC Balanced Fund. These were the nominees for this Platinum category. And again, like Anthony has said, we have to separate this because of the quantum of assets that they have under management. So the Platinum category is usually reserved for those who have a huge size of assets under their management. And the winner is FSDH Asset Management Limited for their Coral Growth Fund. FSDH Asset Management Limited for their Coral Growth Fund. We hope that they will continue to give investors reasons for them to maintain this position or to continue to do well in the market. We move on to the next category, which is Fund Management Innovation of the Year Award. Again, we have seen what the coronavirus has done to the way that we do things generally in the world. Innovation has come to mean quite a lot. And for this category, we're looking at...
That's wrong. Listen, and
hello?
You're checking the wrong things. It's okay, you can continue.
Continue. All right, we are looking at funds. We have funds that have been innovative, or fund houses that have been innovative in the assets that in the way they manage their assets and the product that they put out. In that category, we have FBN Edge from FBN Quest Asset Management. There were two nominees there. We have Invest Now from United Capital Asset Management Limited.
Sorry. Take me out.
Anthony?
Yeah, thanks so much, Philip.
We have two nominees. I mean, we have given this product as the most innovative for the year.
Yes. Yes, when we're talking about technology innovation, in the industry, from our research, these are the two real products that we can come up with, but that doesn't mean they've done everything they're supposed to do. They still have a lot of work to do. For example, FBN Edge is still testing their products. And Invest Now, fine. Their team, United Capital Asset Management team, they provided a lot of support for their Invest Now products. But for now, we will wait and see how the two products actually perform in the market, while we are waiting for most other fund managers to come up with their own technology products. Thank you. So for now, we're having them as joint winners in that category.
Okay, so we thank you very much for that clarification. We move on to the next category of award. We have dollar-euro denominated fund manager of the year. Yeah. Nominees are First City Asset Management PLC for their legacy USD bond fund, United Capital Asset Management Limited for their Nigerian Eurobond fund, and Stanbic IBTC Asset Management Limited for their Stanbic IBTC dollar fund. These are the nominees. And the winner for this category is First City Asset Management PLC for their legacy USD bond fund. Is the winner up?
Yes, yes.
The winner, I think the IT team are trying to sort that out.
Okay. We congratulate the winner, the First City Asset Management PLC Legacy USD Bond Fund. Congratulations.
Thank you so much, Business AM. Thank you so much. We really appreciate it. My name is Tony Akinde, representing FCMB Asset Management. Our name changed end of 2019. We used to be First City Asset Management. We're now FCMB Asset Management Limited.
Thank you. Thank you so much, FCMB team. And thanks so much for Philip for helping us to announce the winners. Now, you remember that during the panel session, there was a questions and a discussion on whether the value of asset management actually matters while trying to assess the performance of mutual funds generally. Yes, during our research, we realized that the asset class where the value of assets under management actually matters most, we are saying this with authority, is the fixed income category. Is the fixed income category because of primarily because of the management fee that you pay, because it is fixed, because the management fee is fixed. So in analyzing the winners, we actually had some challenges because we realized that the funds with the best returns are actually funds with relatively small assets under their management. For example, Ancoria Asset Management, they have, as at the end of 2020, they had an asset under management of something in the range of 480 to 520 million naira. Whereas some funds like some funds have, like, for example, first, FBN Capital Asset Management, they have I think their fixed income fund is something, is something in billions. So now the question is, how do you rate them? So in order to do that, we have to break the fixed income categories down to the value of assets. We have to create another category called silver category. And instead of having nominees, we have what we call honors list. When we say honor, we are simply saying that all of them that are on our honors list, they all did very well, and they all did very well, and we are very proud of them. So on our honors list, we have Stanbic IBTC Asset Management for their Stanbic IBTC Conservation Fund, their sub-fund. Also, we have Ancoria Asset Management Limited for the Ancoria Fixed Income Fund. We have Lead Asset Management Limited for the Lead Fixed Income Fund. We have Coronation Asset Management Limited for the Coronation Fixed Income Fund. We have FSDH Asset Management Limited for the Coral Income Fund. Stanbic IBTC Asset Management again for the Stanbic IBTC Guaranteed Investment Fund. It's like Stanbic IBTC, they have close to, they have about 4 or 5 fixed income funds. And also we have Zenith Asset Management Limited for their Zenith Income Fund. But before we even announce winners, I would like to ask Odiri. During our research, we realized that SEC, in their data, they separated bond funds from fixed income funds. I don't know, can you give us an insight why you think they did that?
All right, interesting question, because we see that often. You see funds are classified as fixed income fund and another set of funds classified as bond funds. But I think to a large extent, as long as the underlying asset in these funds are the same, whether they are called fixed income fund or they are called bond fund, they are all in the same category. So the SEC has aligned the asset classes and the asset allocation for fixed income fund and across other funds. So basically, if a bond fund has 70% invested in bonds and a fixed income fund has 70% minimum invested in bonds, I think both of them are in the same category. So to a large extent, I think it's just in nomenclature. For United Capital, at the beginning of last year, we are still called bond fund. But in the course of the year, we changed our name to United Capital Fixed Income Fund. You know, the underlying asset classes, the asset allocation, the structure of the fund did not change. It was just basically a change of name. So you could be called a bond fund, you could be called a fixed income fund. I think basically, in my opinion, it's still the same as long as the underlying asset classes are still invested in bonds. They are basically the same.
Yeah, thanks so much. I don't know whether Delege has any contribution to that.
Sorry, I would agree with Odiri. The underlying assets are more or less the same. It's just the nomenclature that is different. But with the new SEC rules, that has been aligned, and they fall within the same category.
So in your opinion too, is it right to categorize US denominated bond funds as fixed income funds?
They are fixed income funds, actually, especially the ones that are termed Eurobond funds, the fixed income funds. It's just the currency denomination that is.
Denomination that.
Yeah.
Thanks. So for this category, our winners for the fixed income fund categories are, for the silver category, we have joint winners. And our winners are Ancoria Asset Management Limited for their Ancoria Fixed Income Fund, and also Lead Asset Management Limited for the Lead Fixed Income Funds. And I would like to explain this here that in the next 2 weeks, we are going to publish what we call a post-award supplement that we actually explain the methodology we adopted in applying, as in we adopted in arriving at our winners. it will be detailed. The data used are data sourced from SEC. Why we used Ari Markowitz portfolio optimization model to calculate the returns on assets and the risk involved in all these assets. So we encourage you to look forward to that report that we promise will be a collector's items. So for the fixed income managers of the year silver category, our joint winners are Ancoria Fixed Income Fund from Ancoria Asset Management Limited and Lead Fixed Income Fund from Lead Asset Management Limited. Then we go to the gold category. I have to be specific here. Even while calculating the returns, the fund that had the highest returns in fixed income category is Coronation Fixed Income Fund. But the total assets under management is less than 3 billion. The assets under management of both Ancoria and Lead are less than 1 billion. The assets under their management range from between 500 million to 800 million, while that of Coronation Asset Management Limited ranges between 2.5 and 3 billion. But in terms of returns, they had the highest return. They had their highest returns under fixed income categories. And for that, they are the winners for the Fixed Income Manager of the Year Gold category. Fixed Income Manager of the Year Gold category. The award goes to Coronation Fixed Income Funds from Coronation Asset Management Limited. Then when we now talk of assets under management that is 25 billion and above, then in that category, our winner is Zenith Asset Management Limited for the Zenith Income Fund, the winner of the Fixed Income Manager of the Year Platinum category. They have assets under management of over 25 billion, and their returns last year is over 8%, which in the category they belong to, they have the highest returns for all fixed funds that have assets of 25 billion and above. Then we come to, I'll go straight to ETF Provider of the Year. I'll go to ETF Provider of the Year. Before we announce the winner, I want Dixon Ifeoluwa to actually explain to us what investors should be expecting from the ETF categories, from ETF funds this year. Actually, the problem is they did very well. Most funds in ETF categories, they gave very good returns. But the question is, should they be categorized as mutual funds? Ifeoluwa.
Good.
Of mutual funds, there might be sort of derivatives instrument, but for the ETFs, they're more clear-cut as derivatives. Like Dixon said, the class of investors will be qualified investors, and I think that the market is not yet matured enough to accommodate ETFs, which is why you find a lot of fund managers are not playing in that field. I think it's a more complicated space than the regular collective investment schemes. I wouldn't say I'm an expert on ETFs at the moment, but I mean, they are like, my understanding of it is that it's a closed-end fund, whereas the collective investment schemes are open-end funds. But I think they're not, they can't be classified as collective investment schemes like the other funds because of the way they operate. Thank you.
Okay, thanks so much. The Vertiva Fund Provider of the Year, sorry, the ETF Provider of the Year in the country is Vertiva Fund Managers. I don't think anybody would dispute that. They have the highest number of ETF funds in Nigeria, and their funds actually gave the highest returns in Nigeria last year. Thank you. Yes, before we announce the winners in the Money Market Fund of the Year category, I would like to ask Odiri, why looking at the returns, why trying to calculate the returns on the money market funds, we realized that most of them actually didn't change values from January to December. What do you think happened?
Sorry, you said most of them didn't change values in terms of size or in terms of return?
In terms of bid offers and all that.
Okay, so the money market fund compared to the other funds are priced at a price of 100. So it's fixed at 100. So your money market is always a 1 naira, because interest accrues on the fund compared to the other nature of mutual funds that we have. For money market fund, it's different in terms of the valuation. So your valuation is priced at 100 naira or 1 naira. And so, yeah, interest accrues on your investment so that at the end of 90 days, you are paid out that interest that have accrued up to that 90 days, and then you start again from your principal to accrue. So the valuation for money market is different from the other fixed income fund, like bond fund, fixed income, Eurobond funds, and even the equity fund.
Okay, yeah, thanks so much. Thanks so much for that explanation. Because at Business AM, in everything we do, our integrity matters. In everything we do, our integrity matters. So for now, for the Money Market Fund Manager of the Year, we won't announce the winner now. We have to go back and do some background checks on our research. We have to look at our research again. Because for us, it's not just about giving awards. For us, what matters to us is integrity. We want our awards to be our bonds. When we say anything, we want to be able to stand and defend whatever we say. So we go to the biggest award of the day. And that award is the Fund Manager of the Year Award. The Fund Manager of the Year Award. And our nominees in that category are Stanbic IBTC Asset Management Limited. By every measure, Stanbic IBTC Asset Management Limited is the biggest fund management, is the biggest asset management company in Nigeria by size. They have assets in almost all the funds classes. And practically all their funds are doing very well. Yes, the other nominees on our list is United Capital Asset Management. United Capital Asset Management is not as big as Stanbic IBTC, but in terms of performance, I think they gave one of the best performances last year across board. Why? Fine. From me personally, the surprise member of that of our nominee list for the fund manager of the year 2021 is FSDH Asset Management. When I say surprise, yes, I was actually looking at, when we wanted to start, I was looking at some other houses. But when we started research, we realized that across board, most of their funds did very well. Almost practically all their funds did very well. So, but the fund house that gave the best values, that gave the best returns, according to our research, is United Capital Asset Management Limited. And for that, they are the winner, they are the fund manager of the year 2021. Thank you. I think they have a video. Okay. So United Capital Asset Management, okay.
Ladies and gentlemen, Business AM for putting together. I am extremely honored to be Asset Management Company of the Year and Best Equities Fund Manager in the Platform Management Innovation of the Year Award. I'm grateful for the recognition of United Capital Asset Management as one of the firms contributing to the growth of the mutual funds industry. This award is dedicated to the amazing team at United Capital. Thank you once more, Business AM. We look forward to winning more awards in the future.
It's really an honor. Congratulations to every one of you. To United Capital. asset management, we have always known you to be bullish, in terms of your activities in the market. Sometimes even from the long time that I've used in observing the work that you do, from your former managing director, group managing director, the lady, very active. And so United Capital is very, very, very active, in the market. Now, of course, we know that they say early movers, so when you look at early movers, you look at the Stanbic IBTC from our days covering the capital markets and what they started out doing, so it's not a surprise that, they cover, their asset under their management is 50% or more of the market, so that's expected from early movers, as they would say. But United has always been bullish and been very active. The same would be said of FBN Quest. We know, and then you look at Ancoria and the ones that are coming up in terms of the size of what they have under their management. Efficiency is always important, because we think efficiency is at the root of people like companies like Ancoria and the other ones having a small asset under their management. So efficiency will be a driver of them getting nominated and playing a big role in terms of the returns that they bring to their clients and investors. So I say congratulations. So we will continue to do this. We'll continue to look at what you're doing, continue to monitor what you guys do, because at the back of every journalism business is to ensure that those people you call your clients, those people you call investors, get enough information to be able to make informed decisions. So congratulations. We'll be looking forward to this happening again next year, by which time we hope that vaccines will have been populating the whole of the country, and then we'll be able to speak. Perhaps this will be held face to face. The vaccines will have taken root, and then we'll be able to see each other from face to face, not via Zoom. And then the award will really take on a different shape. So congratulations to all of you individually, and then to the big winner, United Capital. We hope to cover you even more deeply because of this award that you have won. Thank you very much.
Yeah, thanks so much, Philip. And I have to say this about FBN Quest Asset Management. When we started this research, of course, when we're talking about the biggest prize in this award, their names came up. And but I think Dixon said something that, sometimes maybe the methodology we used did not really align with their strategy for the year, because during the discussion, she said something that sometimes a fund house can decide in a particular year to re-strategize or to reinvest or to probably invest in technology or innovations and all that. And sometimes it takes time, it takes years for that to, it takes years for the result of that to show. So, but that doesn't take anything away from the strength and the efficiency of FBN Quest Asset Management. They are one of the strongest in the industry. And to all the award winner, congratulations. And don't forget, in 2 weeks' time, we'll be coming up with a post-award supplement that we promise will be a collector's items. We'll reach out to some of you on how you can participate in the post-award supplement. Thank you. We hope to see you next year. Bye.
Thank you very much.